Good morning, everyone. Appreciate you jumping on, joining us as we get near to the holidays. Hope everyone's getting ready for Christmas. We're really excited to have you join us. We'll just wait a couple minutes. I see we've got a few participants joining us. Feel free to shout out in the chat. Let us know who's here if you would like, and comment in the chat. But we'll wait just a couple minutes before getting started here. Randy, appreciate you joining us here. Good morning, Kathy. Happy holidays to you guys, both of you. Happy to have you all joining us. Okay, we'll go ahead and just get started. I do want to introduce our special guest today on the webinar. We have Matthew Swan, who is the managing partner of Swan Gardiner CPA. He is an expert when it comes to all things tax planning, tax preparation, strategic planning. So we're super grateful. Thanks, Matt. Thanks for joining us.
Glad to be here, Zach. Appreciate you guys asking me to come and share.
So let me just introduce Matt a little bit more. Matt graduated from Idaho University with an accounting degree in 1984. He became licensed in 1985, passed the CPA exam. He worked at Pete Marwick for 2 years in Midland, Texas, and then moved here to Vegas, Nevada. He's been started his own firm in 1990. And has formed this partnership with Bruce Gardiner. The firm's quickly grown, and now they have 15 staff. Matt, is that right?
Well, we're going to be up to about 20 here come tax season. So, yeah, we're growing.
Yeah, that's great. And we work very closely with Matt. So he works with a lot of corporations, partnerships, works with pension plans, trusts. Very, very knowledgeable, and he is an expert, so we're excited to have him. I'll go ahead and just turn the slide deck over to him, Matt, and we can go ahead and get started.
All right. I appreciate it, Zach. It's a privilege to be here today and be able to share some of these insights. This is kind of the fun part of my job, is being able to share these insights that help people with their taxes and that. So it's kind of fun to come and do this stuff on that one. So first off, the first point that I wanted to talk about, which most people will be able to use this, is this tax loss harvesting concept. What it is, and especially to do this towards year end. So right now, get with your broker and ask them about this tax loss harvesting on that one. But what it is if we have some gains and some losses for the year, we can take those losses and help offset those gains and maybe even zero out our tax liability on those gains that we might have. If you look at that chart on there that is up there, if your taxable income is in that first bracket there where you see the 0% on there, if your income is below, say if you're married filing joint and you're below the $83,350, you might want to take some gains because if it's long-term capital gains, it gets taxed at 0%, Zach. And so that's really kind of a good deal for some of these people. If they're maybe retired and they're in a lower tax bracket here, they might want to get with their broker and say, hey, here's where I'm at, and their tax preparer. Here's where I'm at. How many gains can I take this year? And then when that's decided, they might want to then take a look and say, okay, but what losses do I have? Because I might want to take some losses to help offset that. And let me go to this next slide here. The losses that we can take can be used to offset capital gains from selling investments in our brokerage accounts or any other assets, such as maybe real estate, could be land, could be anything else that we might sell that creates a capital gain that we can use these losses against. And capital gains distributions from mutual funds, we can use these losses to offset that. These losses come from, again, getting with your broker like Arista Wealth here and asking them, okay, what losses can I take to maybe offset some gains? They might not know that you've sold some other asset, such as land or real estate or rental property, where that you might have some capital gains on that. So this is one of those times when it's just nice to be able to talk with your experts here at the end of the year and just let them know what's going on, that we might be able to take some losses here to offset this gain and help reduce your taxes. Understand that if we take a whole bunch of losses, we basically use that up against the gains first, and then we are limited to taking 3,000, as it says there, used to deduct up to 3,000 against non-investment income. That'd be like ordinary income, could be wages, interest, dividend type of income based on that. And then we get limited at $3,000. If we have more than $3,000, then that carries forward. Some of you might remember we could carry them back a few years. They've taken that away now and we can't do that. And so it has to carry forward. So it becomes a little strategic in working with your broker and your CPA and working these tax loss harvestings out so that we don't take a whole bunch of excess losses and then we just have to carry them forward and hope we have gains going forward on that. This next slide.
Yeah. Jump in for just a moment. A common question that we get from clients, participants, other people is, how long can we use those losses? The expiration, people say, is it 3 years, 5 years, forever? Would you go in and clarify that a bit more for everyone on the
Yeah.
call?
No, that's a great question. Right now, the way the tax laws are is this carries forward basically indefinitely on these losses. So it just keeps carrying forward until we use them up. So it's one of the few that don't get limited. There's other carry forward items that you're talking about that most of the people are probably hearing about, where it gets, we only get 3 or 5 or so many years that we can carry it forward and then it drops off, type of a deal. But in this one, this is one of those ones where it basically just keeps carrying forward until we use it up, or hopefully use it up on that. So again, this might also be a tax planning. If we do have these losses that are carrying forward, maybe we take a look and take a bunch of gains this year because we have the losses to offset that too. Now, this year probably, and Zach, you guys have probably been getting a lot of things, but this year we probably have received more losses, I'm assuming, for most people than we have gains, as opposed to like a year ago. We had a whole bunch of gains and we were trying to find losses, which was sometimes hard to find too. In that case, we didn't have very much in losses on that one. But again, this might be one where, depending upon your tax situation, that we might want to take some gains, even in excess of the losses. But again, that's talking with your advisors on that one. So to try and maybe explain that a little better, this next slide here, if you look at this right here, if we had 20,000 in gains over here on the left-hand graph there, part of the graph, and they were all short-term gains and we didn't do anything else with it, Zach, then we would pay the taxes. If you see that, over about 7,000 in taxes if you're in the 35% bracket. Well, that's a lot of tax to pay on something when if we go over to the next column and we take 25,000 of losses that we have for the year, and we need to take them before year end, that's why we call it kind of this tax loss harvesting. We have to harvest this before year end in order to make it good for this year. But if we take $25,000 in losses, we can take that 20,000 and use it against the gain, this $20,000 gain. If you see that, we use up 20,000 on that one. We then can use another 3,000, as you see down below there, 3,000 used to offset ordinary income. So we get a little bit of a tax break there. And then we'd have $2,000 that gets carried forward for any future gains that we might have that we can then use at that point in time to offset that. And that's where it just carries forward into your tax return, and it's usually notated there in your tax return on Schedule D. If anybody really cares about that, they can look at that and see if they got any losses that are carrying forward on that. So that's kind of what is a good example there of what you might be able to do at year end to help save in taxes. And this can affect pretty much anybody, any of your clients, most of my clients who have investments like this, and or have maybe, like I said, a unique sale during the year where maybe they sell some real estate or something and they have a big gain, and then maybe we want to try and take some losses. So we can use this. And in this case, in this scenario here, it doesn't really matter if it's long-term or short-term gains or losses. We can use long-term losses to offset short-term gains, or short-term gains to offset long-term losses, and that. So that's kind of a nice thing that we can do for tax purposes here right at year end to help things on that one. And then also, like I mentioned before, if we're in one of those lower brackets that we might get on long-term capital gain, that we might get zero tax on that one. And so maybe we want to take the gains and not necessarily the losses this year if we're in one of those, that low bracket on there. And then we pay zero tax on it, and that's even better. Let's see, there's a question here. Since 20,000 from Randall, if 20,000 was below the 83 allowance, would there be no taxes anyway? Yes, that in that kind of point there, well, we'd have, depending upon the income that you might have on there, we'd have some ordinary tax to pay, but we'd have zero capital gain tax as long as it was long-term capital gain on there. But again, we still might want to take some losses if we can use up 3,000 of that type of a deal too. But again, there's another slide here later that talks about maybe just taking minimal losses might not be to the best of our advantage on that. So hopefully that answers your question, Randall, on that. If we're in those upper brackets, then by all means, we want to try and take a look at some of this. Tax loss harvesting, take some of these gains and be able to use them up. Let me slide here to this next slide. As we talked about, there's this rule a lot of people don't know about. It's called the wash sell rule, that basically says that if you sell a stock 30 days before the date of sell or 30 days after the sell, and you end up buying it back within those 30 days, either before or after, that you can't take the loss. So what you need to be careful on is if you're doing some of this tax loss harvesting and you're selling some of the stock at a loss, just make sure that it hasn't been bought back, or you don't buy it back within that 30 days before or after rule on there. The same or substantially identical. So if we sold, say, ExxonMobil for a loss and turned around and took that money and bought, I don't know, Procter & Gamble, those aren't the same on that one. But this is where one of those deals where your broker has more of the input on whether it's the same or substantially identical. Your tax preparer probably really won't know that, but the brokerage statement will come in and say whether it's a wash sell or not. And if it is, then we have to add the loss back, or we can't take the loss. So just be careful on that one if you do that, because this could limit you and come back to kind of haunt you in the tax planning part of it. And we see this a lot on the brokerage accounts here lately, that the brokers actually put it in this wash sell on there that we then have to account for and actually kind of not take the loss or add it back type of a deal. So it ends up being zero for tax purposes. Let me go to this next slide here on that one. And this is where I was kind of talking about sometimes, again, get with your broker, see the analysis on that one, see where we're at. But sometimes you see that last part down in here, this, keep in mind, if the loss is less than 2,000, sometimes the transactional costs or tracking costs can far outweigh what we save in taxes. So that's a question then with your broker. If that's basically all that we have, you might be better just leaving it and not taking that loss and letting it carry forward. Does that make sense, Zach?
Yeah, absolutely. And so that's where we can come in as the fiduciary advisor, as an RIA and really give you some advice and say, we can use this, and we can send over those losses captured to your CPA. Matt and us, we're always in communication. We're always in lockstep. We've captured these losses for this client. How can we use this strategically? So yes, you just want to be in communication with us as we capture those and take care of those things for you.
Yeah. Another thing that, just to throw this out too, a lot of times people are trying to sell some real estate, is usually where we get it, and it kind of gets locked up and it actually doesn't close until January of, say, next year. But it's in works and we know it's coming, and that if we have some losses this year, we might want to go ahead and take those, even though we can't use them until we have the gain next year, but at least those carry forward into next year too. So if you have maybe one of those circumstances on that, it doesn't happen very often, but every once in a while I'll get that too. And so we'll end up taking some losses this year that we know that we can use against that gain, even though we have all the next 12 months of next year to do that. It just might be that we have some losses that we just want to go ahead and take this year, knowing that we'll use them up next year too. So I just throw that one out, just a little tax planning tip also. All right, let me go to this next one, item number 2. This is a little more for business owners. If we need to purchase some assets, and there's a list there: vehicles, furniture and fixtures, equipment, machinery, qualified improvements to either buildings that you own or places that you rent, you might have to do some improvements there, or computer and software, that for this year, 2022, we still have the bonus depreciation. Now, if they don't change it or extend it going forward, this bonus depreciation was 100% for this year and the last few years. They're now going to start taking about 20% of it away each year starting next year. So this bonus depreciation goes down to 80%. We still have what we call the Section 179 that we can take and use against equipment like this too. So keep that in mind too. But this is, again, mainly for business owners for year-end tax planning. If you need something, maybe now's the time to go and buy it. Again, if you need it. I've had some clients go out and buy something for the tax break and then bought a vehicle for a tax break and then just sat there in their lot. You know, that's not a very wise use of money. Sometimes it is cheaper to pay the taxes than to go spend it to save taxes, but you're spending $1 to save 30 cents and then not using it. So I just share that with maybe some of the business clients that are on here. Let me go to this next slide here. A lot of times people ask about vehicles. So we might have company vehicles in this first part. If the vehicle is over 6,000 pounds, that's the gross vehicle weight, that basically is the manufacturer's sticker that is put there, usually on the driver's side door on there, where you can look and see your gross vehicle weight. If it's over 6,000 pounds, we get a little better depreciation benefit on it because of the tax laws. If it's under that, then it might get limited. But we get asked this question all the time about vehicles in businesses and what makes sense type of a deal on that one. Again, you need to keep a business log, a travel log on there so you can mark your business miles down there. If you have a vehicle under 6,000 pounds, a lot of times I find just because of the gas mileage, it gets much better than that. That using the cents per mile is better than trying to depreciate it. But that's one where you just have to work with your tax preparer and see what works for you if you buy a new vehicle. The other one that might affect a lot of people, anybody type deal, is this tax credit for electric vehicles. Now, for the last few years, it depended upon the make, the model, and when it was purchased on here. But the deal is with these electric vehicles, there are some credits that can come that can be helped from a tax standpoint, even if it's not a business vehicle, for business use type of a deal. There's a question that popped up. If it's used partly for business and partly personal, can you still take it? Preston asked. Yes, you can still take it, but that's why you keep that mileage log. So if it's 70% of the miles is business, then you can only take 70% of the allowable depreciation and things like that. So just keep that in mind. So jumping back to the tax credits on electric vehicle, there's a law that just was recently passed on electric vehicles that might make it, though, if you're looking to buy an electric vehicle, might make it actually better to buy it next year in 2023 for that $7,500 credit, and that's a tax credit, so that offsets your tax liability dollar for dollar on that. And so that's not a bad thing if you're going to be looking at buying an electric vehicle anyway. So just take a look at that, maybe check with your tax preparer on that one if it makes sense for you. Also check, if you're buying it this year, check with the dealer to make sure that that vehicle that you're buying actually qualifies, because you get it up to a certain number of vehicles that they sell, and once they're over that limit, then that credit goes away. So I've had some people who have bought electric vehicles, and then when we looked at it, all of those vehicles were used up, and so they got zero credit, even though they were thinking they were going to get it. So just check with your dealer on that one, and that'll help a lot in making some decisions on that one. All right, let me go.
Yeah, we've got another question here in the chat about tax loss harvesting. Great question from Rick Watson. He says, is it possible to take a tax loss harvest on a 401k mutual fund?
That's
I think that would be great to go into taxable versus, tax deferred accounts.
Yeah, great question. I get asked that all the time. It didn't pop up here in mine that I could see, but and I get asked this question all the time, Zach, probably just like you do. If it's inside a retirement plan, all right, doing that tax loss harvesting is going to give you no tax benefit whatsoever because it stays inside the plan. Even if you pull the money out, when you pull the money out of a retirement plan, a 401k plan, an IRA, a SEP, those type of plans, if you pull it out, the IRS has already said that's ordinary income, not capital gain type of income. So you don't get any of these tax loss harvesting benefits from doing it inside a 401k plan, retirement plan of that sort. It's a great question. We get asked that all the time, don't we, Zach?
Yes, yeah, very common.
So yeah, thanks for bringing that up on there. So, okay, so let me move on here. Next, I want to talk about charitable giving, because again, this is something that at year end, a lot of people ask questions about on that one. The last couple of years, because of the COVID, we were allowed to write off cash contributions to a qualified charity up to 100%. That has gone away for 2022. We are now down to what you see as 60% of your adjusted gross income is what AGI stands for. Adjusted gross income is basically when you total up all of your income to begin with on there, and that number basically kind of, as it totals up to, that's your adjusted gross income. So your charitable contributions, if it's a cash deduction, we can go up. So if you had 100,000 of adjusted gross income, you can deduct up to 60,000. If you qualify in other places, you can deduct up to $60,000 of charitable contributions. If you notice the next line down, if it's non-cash, So if we were giving stock to a charity, and we'll talk about that a little bit later because there's some questions and issues on that one that usually come up. But if we do non-cash deductions, so if we're giving a car or clothing or certain things like that that we get on that one, that gets limited to 30% of your adjusted gross income. So you get less of a deduction for that on that one. One of the other things that a lot of people are getting more and more questions on, Zach, I bet you're getting more questions on this too, is these people who have to have the required minimum distributions from their retirement accounts. They can now make an election to have that required minimum distribution go directly to a charity, and it gives them, in some respects, in a roundabout way, a tax deduction because they don't have to pick that up as income like they have been. If they took a required minimum distribution, they have to pick that up as ordinary income. And then if they do the charity, the contribution on there, then in the end, it might net up. But by going this way, it might keep them down into that lower tax bracket. And then we can take some of those gains too and pay zero tax on this. So it becomes a little strategic in doing this required minimum distribution rollover. But they can go up to $100,000 of their RMD that they can send to a charity there and not have to pick it up as income. If they're married filing joint, each spouse can do $100,000. So they could do $200,000 on that one. So just keep that in mind. Again, that's one where, and Zach probably gets involved a lot in this too, Arista Wealth people, where people need to know what their RMD is because they're of that age where they have to take that. And so this is just an example here, Zach, where we can, both of us can share with our people that we work with this option that they could do something like this. And so I've done it with several people now where we've done that, and then we were able to take some of the gains on the stock and still keep them on a married filing joint under that $83,000 and paid zero tax on the capital gain portion of it. Let's see, there's a question down here. Can you roll over charitable giving deductions if it's over the AGI limit, and does non-cash contribution overage carry forward? Yes, it does. There is a limit on those. To carry forward, I believe it's 5 years is what we can carry over charitable contributions on that one, but it does carry forward if we do that. So again, it's a little more strategic on, you know, when you do these charitable contributions, if we do that. Now, we'll go into a little bit deeper concept here, but this is called a donor advised fund. And if I remember about a couple of months ago, Zach, we had somebody on one of your webinars who talked about specifically about donor advised funds. And I really appreciated it and learned a lot myself from that webinar. So I appreciate you guys doing that. Wow. But let's say we have somebody who maybe comes into a lot of money that's going to be taxable. Maybe they sell their business. They decide to maybe cash out on some investments, and they have this huge gain. And that we might want to then set up, as was explained. And if you want more information, I would suggest you go back to that webinar a couple of months ago and get even more detailed information on it, or just call us and we can talk you through this too. But set up this donor advised fund. The really neat thing about these donor advised funds is that you can put a lot of money into it. And if I sold my business for, say, 10 million this year, and I get limited to 60%, if it's a cash deal, I could put $6 million into this donor advised fund and get a tax deduction for it. The really cool thing about this donor advised fund, though, is I put the money in, I get a tax break for it in the year that I put it in, but I can then decide with my advisor, you know, over several years, how I want to distribute this money out. And it could go to several different places and that. Then the next year, because I don't have the sell of my business, my income drops back down and I might get limited on that one. Well, this is a really great tax planning tool because I took advantage of that 60% limit when my income was way up and got a deduction all in 1 year. And then over the next few years was able to distribute it out to qualified charities doing that. You can also do this with non-cash type of things, but there's certain rules with that one. That's one of those ones where get with your tax advisor or brokerage advisor so that you can talk with somebody who's qualified in the donor advised funds and get direction that way, is what I would say from that one on that.
Matt, if I could just add something onto that.
Please.
We have a lot of wonderful clients who are making great charitable contributions, whether that's tithing to a church or to other charities. These funds, they really open up the door to a lot of different things that you can do with your charitable contributions. You can set it up as a legacy. So even after you've passed on, that donor advised fund can continue to make contributions in behalf of you, on behalf of your estate. You can donate that money, have it in the funds, keep it invested in stocks. We can help you manage that. And then after you've passed on, those checks can continue to go to the church. Those checks can continue to go to the church or to other. And so it's a really great way to plan for your legacy and what you can do with your estate.
Right. And I believe that there's some estate planning things here too that benefit that way, but talk with your estate and trust attorney on this part too. But again, there's just kind of an example here. I had an individual wanted to do something like this, but wanted to set up kind of a scholarship fund for the university that he went to. Another one wanted to do it for a qualified trade school because he was in manufacturing and construction type of a deal, and wanted to help kids to come up so that so they might learn a trade here and that. And so I've seen a couple of those in there so that they could kind of spread that out over years instead of trying to do it all at once. It's just a really kind of cool idea that's available for people who might have this unique situation where they have a lot of taxable income in 1 year, especially. I mean, they can still do that, don't get me wrong, but I usually see this a lot of times when, something happens and they have a large tax hit type of deal on here. All right. Let me move on to the next one here. This isn't necessarily, we don't really get much tax benefit right away from this. Let me put it this way. But a lot of people come and ask about gifting money to their kids or to other people. And that for 2022, the limit so that we don't have to report it on a gift tax return, let me clarify that, and I'll clarify a little bit more, is that $16,000 per person per year. So if I had a child who was married, I could gift $16,000 to my child, and I could give $16,000 to my daughter-in-law. My wife could gift $16,000 to my son and give $16,000 to my daughter-in-law. So it's a way of then maybe for some people, they might be trying to get some of their estate down and gift some of this money to their kids early on while they're alive. That this gift taxing, or this gift tax here basically can be done here, that we can transfer this to them. Now, the deal is though, is my gifting to my children and daughter-in-law, I don't get a tax deduction for that. But my children don't have to pick it up as taxable income either. So it's just a way of spreading out my estate amongst my kids, if you will, in this case, while I'm still alive and not having to then file a gift tax return and do all that. I can gift more in a year to somebody, but if I gift more than that $16,000 to a person, then I have to file the gift tax return and do that. So I'm just letting people know that yes, you can do that, but there are additional consequences that you then have to do and report. That when you do that, that eats up part of your $12,060,000 per person of your estate before we have any estate tax. That so if I gifted 100,000, I take the 16,000 off, and then 84,000 reduces my 12,060,000 for my estate on that one. And that's why the gift tax return has to be filed. You don't pay any tax right there at that point in time in this scenario, but it does reduce that upon my demise when I pass away. So I just wanted to bring that up, that's an opportunity, and it's by year. So if we haven't done it, we want to do that, do it before year end. What I usually suggest is they, do it like in a check or transfer and put, gift to Zach, and tell them to try and cash it before year end. It's always better that way. So,
Matt, if I could just add a couple things
please.
Here, people often think, well, my estate's under that 12 million threshold. I'm okay. This is not a strategy that would be beneficial.
Yeah.
But right now, as of 2020, as of the current legislation, in 2026, that exemption limit is set to drop down to 5 million, where it was back in 2018. So if your state is over 5 million, you're going to hit that 37% tax bracket very, very quick. So you'll have the 5 million exemption, and then $13,000, and then you've hit that 37% tax bracket. And so you could pay some really hefty estate taxes when you're passing on those assets. This $16,000 that Matt's sharing with us is an annual limit that you can gift that doesn't go against that limit. And so for individuals that have very large estates, this can be very beneficial if you're trying to move that wealth from generation 1 to generation 2 and to generation 3, to use that limit. That annual limit also expires. So if you don't use that 16,000, you don't get an extra credit the next year. This is just an annual limit rolling forward. And so it's definitely something to be aware when you're starting to really consider estate taxes and how that comes into play.
Yeah. Thanks, Zach. And yeah, keep that in mind too, that at the end of 2025, if nothing happens, it drops back down to 5 million, maybe subject to some inflation adjustments or whatever else is what I've read now. Yeah. So now is a much better time to be planning if we're going to do this anyway, type of deal, that it might be worth it doing it now while we still have a little bit of time too. So, but thanks, Zach, for jumping in, and I appreciate your input on that. All right, we'll go to this last one, and I loved, Preston actually found this cartoon and added it in there, and I love this because it really says it. And I only had to pay tax on the seed. It's just really great, and it's so true. That's probably the funny part on it, because on a Roth IRA, we know that when we put the money in, we've already paid taxes on it. So that's the seed, if you will. But from there on out, the Roth IRA grows tax-free. And even when it passes on to your beneficiaries, your heirs on that one, it's tax-free to them also. So this is another great tax planning tool, not only for yourself, but going into the future on this too. So in this part, I want to talk about doing Roth conversions, and I'm sure, Zach, you guys get hit up all the time on this too, because you guys are involved in this part. Yeah. And so sometimes we might have an IRA or a 401k plan, or we had a 401k plan that has now been moved to an IRA type of a deal, that we want to maybe take a look at converting from an IRA to, says, a non-Roth account to a Roth IRA. The advantages, again, of this, now, when I pull that money out, I'm going to get taxed on it. But if maybe I'm retired and my income is substantially dropped, I can pull this out and I'll pay the taxes on it. Might be at a much lower rate than what my children might inherit my traditional IRA at, because if they inherit a traditional IRA from parents, they then have to pay the taxes on it if it hasn't been pulled out at that point in time. And our children might be at that point in time when they're making some really good money and they're in a higher bracket than maybe us parents are. And so we might want to convert this to a Roth IRA and make it this tax-free. So again, remember, if we do the conversion, we have to pick it up as taxable income. So again, it might be one of those deals where we take a little bit or some every year and do this conversion as we go forward and try and keep it within those tax brackets that make sense. Again, that's talking with your financial advisor, with your CPA, tax preparer on something like this. The other note on there, Roth IRAs don't have required minimum distributions like other retirement accounts. So depending upon if you were in the 70.5 rule or now the 72, if you haven't reached that age, now and it's now moved to 72, you have to take required minimum distributions out of taxable. So like a traditional IRA, 401k plan, that money that comes out, you're going to pay tax on it. If we convert it to a Roth and we pull any money out of it, it's tax-free. We don't pay tax on it. So it's just maybe a tax planning tool that affects lots of people. The Roth conversions, that next point, the Roth conversions can be taken tax-free and with no 10% additional tax for early distributions, as long as we had it open for 5 years, that Roth account on there. So keep that in mind. It's just open for 5 years on that. So we might have made one contribution into it and then 5 years later type of deal. And then what we talked about, note that Roth IRA conversions will trigger ordinary income in the year of conversion because you're taking it from a traditional IRA or 401k plan and converting it to a Roth. In the year that you do that, it becomes taxable income like we talked on that one. So again, timing can be really critical when you do this conversion. And so this is another one. Again, please talk with your financial advisors and your CPAs on doing this. But I'm seeing a lot more and more of this. Are you, Zach, are you seeing more and more of these conversions now?
Yeah, absolutely. And Preston, thank you for finding this illustration because it shows it perfectly. Getting that tax-free growth is huge. And you might think, I'm over the income limit, I can't directly contribute to a Roth. And yes, that's correct. But there's a backdoor approach that we can allow you to get that conversion in there and completed, where we make a non-deductible contribution. There's really just some advanced strategies. And so yes, absolutely, this is something that we want to look at for you and see if it makes sense. Let's start doing those conversions and let's grow those tax-free assets. We pay the government too much money already. So
here's maybe, and I didn't have it on this slide, but you just reminded me of something, another little tidbit that I do share with some of my clients, that if they have, younger children that are working and have some income, I strongly suggest, because they're in such a low tax bracket, I strongly suggest that even if they gift their child some money so that they can put it into a Roth account when they're, say, like in their teens or 20s on that, put that money into there while they're young, because when they get into their 60s or 70s, when it comes to, that could be a huge amount and it's tax-free on that one. So starting young doing a Roth can be a huge advantage. And so this is maybe where parents can put their arm around their kid and help them learn something early on in life that maybe some of us has taken several years to kind of learn this and take advantage of, even though Roths haven't been around maybe that long for some of us type of deal. But it's just a good tax planning tool for your children too on that one. So anyway, that's the 5 points. If I go to this, here's contact information. You're welcome to reach out to us if you would like. We'll see what we can do on that one, and appreciate for the time that you allowed me to be here, Zach, and hopefully it was well worth it and people learned something from this. So I'll turn it back over to you.
Matt, this was great. Thank you so much for joining us. Yeah, please save Matt's contact information if you have any other questions. We'll stick around for just a couple minutes. Feel free to throw those in the chat, or if you want to send us a follow-up email later, always happy to review things. But Matt, thank you again for joining us, and thank you for these 5 tax tips. We really appreciate it.
It's fun to share this. This is, like I said, this is a fun part of my job. I tell people I don't want to pay any more taxes than I have to, but I still want to sleep at night. Type of deal. And so it's fun coming up with information like this that can help people so that, yes, they don't pay any more taxes than they have to, and we still sleep at night.
That's great. I love that. I love that. Thank you, everyone. You can jump off if you don't have any more questions. Kathy, thank you for joining us. Rick, appreciate it. Really appreciate you guys all joining us today. Thank you. And if we don't speak again before the holidays, have a Merry Christmas and good time with family, whoever you're getting with. Travel safe if you're traveling, but thank you for joining us.
Hey, I think you forgot this slide too, Zach, and then the follow-up slide. So again, thanks Arista Wealth for putting this together. There you go, right there. On now, and happy holidays, Merry Christmas, joyful New Year. So. Okay, we done?
Yep. I'm just going to hang on here, see if we have any more questions.
Oh, yeah.
We'll just wait just a moment to see if there's
something. I appreciate you jumping in on those, sharing your insights. That was great.
Yeah, absolutely. Okay. Thank you so much, Matt. We can go ahead and end the webinar. Appreciate you.
Yeah, you too. Okay. Have a great one.
See you, everyone.